Wednesday, 25th September 2024. Critical price points as usual. So this is the weekly chart. We measured this candlestick. We see a volume imbalance, this candlestick, and of course we see a inverse if a value gap unfilled in the weekly chart that could possibly drawn up to that. But first, the daily target for today and yesterday was August 2022, the daily high. We didn't get that yesterday, but we got that today. So yesterday was previous day high and previous opening price. Those price points are insignificant because we have these relative points that are all in close correlation to that. And then we have that weekly wick, the 75% range of that. So previous day opening price is a very high point of resistance. As you can see, we trade down into that in the London session. We have the Asian session. I didn't trade the London session. I traded the pre-market, the AM session. Did not trade the lunch and the PM session because I was still in the trade of the AM session. So I had no need to trade the lunch or the PM session. This is then a 1 minute chart. This is the pre-market. All these points up till here, 9:30 in here. You can see lunch, first presented fair value gap, all that stuff. As you can see in here, the new day opening gap today was not very significant because it was a very close correlation to the first fair value gap. We leave these relative equal highs, and of course we trade up to the high. Then we trade all the way down to take out the engineered liquidity and use this point at lunch, the previous day high, as resistance. So then we have the entry model of the Asian session. What do we do with the Asian session? We take from 6 to 7. We take the formed buy side. In this case, it was here, but we traded above that. We showed not a willingness to trade down to the new day opening gap. We traded above that. We saw that buy side was being taken. Then we traded lower. We saw a volume imbalance when we traded up in there. We could have traded that, put your stop loss in here, but I wanted to have some more willingness, some more information. So I wanted to wait for this fair value gap to inverse, which it did. While it did so, it left a fair value gap which traded back into. There I shorted. My stop loss would come here above this high. Usually, but from now on I'm going to put it in here because a lot of the times I would get stopped out and then price would rally higher. So from now on it's the second candle that forms the fair value gap, like it is in the 2022 model. Like if I put it here or here, it's not very significant. The risk is almost the same to take out south side, and of course to trade, have a portion open to lower. Then this is the other entry model. This is 7 till 8 p.m. At 7 a.m. This should be a.m. At 7 a.m. we see relative equal highs form. Then we traded lower to the 50-minute fair value gap. We wait for price to show something significant, which it does here. It traded in the fair value gap the first time. Then it traded in it again to take out this low, and I traded higher, and I will explain that later on. This is what it's all about, and this is basically the summary of the price delivery. So that makes us go to the price delivery. As you can see, previous day opening price is the low of the day, which also is the London, and the high of the day is the AM session. So once again, we have the engineered liquidity, and here we saw price rally down and immediately rally up to inverse this 1 minute fair value gap. So that's the trade that, not yet, I'm not going to talk about that yet, but first we talk about the Asian session. I already kind of did that, so I don't need to do that again. Then we talk about I skipped the London session because I'm not very good at the London session. I still have a lot to learn in the London session, but it was the low of the day, so we can play that because 70% of the time the London is the low of the day, so, or the high of the day, so we can play that. If we are bullish, we have the possibility to position in here This was a nice price point to position in to then trade higher, which is a lot of several hundred pips, handles, excuse me, 200 handles almost. So boom, the pre-market session. As you can see in here, this is the 50-minute fair value gap presented at 6 a.m. Around 6 a.m. candle. Then at 7 a.m. we see relative equal highs form. Then we drop lower. We see that we drop down to the fair value gap of Tuesday, September 24. Once we traded in here, we are very alert. We see sell side is engaged, sell side is engaged, sell side is engaged, and sell side is engaged once again. After this sell side was engaged, we rally up. So we have a low, high, lower, low, higher, high. This candle then makes them the breaker. Inside that breaker, we have a volume imbalance slash fair value gap. And this candle's low and this candle's high makes the fair value gap. And these candles on here have a volume imbalance, so we take that into account. And then we have the fair value gap inside of this breaker. As you can see, the bodies are respecting that. Stop loss would then rest below here, below this candle. We don't get taken out. Once we trade above this, we also take out the target. Not only that, and we trade lower to take out the to inverse this Tuesday's first presented fair value gap of 24 September. We trade down to that. Then we trade up. We do that with momentum. We have a breakaway gap. In here you can see if a fair value gap again. Once it comes down in there, we can have a long entry. Then we have this 50-minute fair value gap. In here there was a inefficiency, also the new day opening gap, and of course we are bullish for the day, so we could have held the target for the high of the day, which was the 22 August of 24. Did I mention everything? Oh no. Then we came in here, we close above here, we see we keep engaging the 50-minute order block. Like I said, this high, this low in here should form like this low and this low and this low. They should all form relative equal lows to engineer liquidity, sell side liquidity. So when the market opens, we could have expected a form first traded down and then traded up, but today we left those relative equals highs open until we first took out the high of the 22 August high. When we did that with speed, that's why we could have trusted the first presented fair value gap, and we didn't need to wait to trade down all the way to that. As you can see, this is the moment we've all been waiting for. This is, what the fuck, this is slow. As you can see in here, price traded down into this fair value gap and immediately traded up. It spent about 2 minutes in here with 2 wicks, and then this is an SMT which was engaged in the ES. Like I said, when market opens, we can expect this to be taken out first and then to do this. But since this was an SMT and we see price rallies up in here, we have momentum in here. We don't need to trade that down to there. When in fact, once we are in here and we show momentum, then this is our next target. So we have the initial sell side, and then we have the initial buy side. Buy side is taken, sell side is not engaged, buy side keeps getting engaged. So once again, we come in here. On the 15-second chart, you could see somewhere in here there was a volume imbalance. We inversed that, and then we traded up higher. We could have used that on the 15-second chart, but I don't have this 50-second data, so I cannot use that. Yeah, we inverse this first presented fair value gap. We see the midpoint of that is getting respected. Then we see these three relative equal, consecutive closing candles, which makes an order block. Then we see this very high wick of that order block. We measure that. We take the consequent encouragement of that. Once it trades down into that, we enter. This also created a order block. So when price traded above the order block or at the closing price of the order block or the opening price of the order block, we can also put an entry and mitigate our risk below the breakaway gap today. No, I don't want to see the breakaway gap getting filled actually. I didn't want, because we are in the macro, and if it traded down in the breakaway gap, then that could have been a reason for us to close the trade. So there were also relative equal highs resting at this level at previous day's high. So once we trade up in there, we see a two down close candles which form a order block. Once it trades above this order block, the opening price, we do that with momentum. We see a fair value gap. We trade down in that fair value gap. We do some damage in it, but the high of that fair value gap, the bodies are staying above that. We also wicked down to the order block. There was no really significant 15-minute price point because the candles were just rallying up. And here we see momentum is getting killed. So we take profits, and once we see that momentum is getting killed, like back and forth, no matter what we do in here, this is, even if we sell, this is the price will go up, which also is an indication that it might just go down later on. Once we do that, we see a fair value gap in here which get filled. Then we move down, we move up, we move down to trade into previous day's high. We do that with momentum. We leave a fair value gap, we trade back into that fair value gap. The bodies are not closing above that, so we trade down, we disrespect that fair value gap, and we do that. While we do that, we have a fair value gap in here, so trade it back inside of that. We could have engaged to the idea that we were going lower to have 1, 2, 3 thrive, but in here I wanted to see some more momentum because we are still pretty bullish and it could still like tap out this. So especially when we took out sell side. So I wanted to see some more momentum. We trade back into this fair value gap. We meander around while we do so. While we trade back into that. Okay, once we trade back into that fair value gap, this fair value gap, that great fair value gap, we do that with momentum. We leave this fair value gap, so we annotate this fair value gap now and this fair value gap now. Once we trade in here and it trades above that, it does that with momentum and then trades back in that fair value gap, we could see higher prices. But it meanders around, engineers liquidity. Sell side is keep getting engaged, then buy side, then this, and then at the end of the macro, we take out all the buy side and we leave this buy side open. We trade to the high of that fair value gap. We trade lower again. We trade lower. We do that with momentum. We leave this fair value gap now, and now I am convinced. And when price came back in here, I took a losing trade. I shorted in here. I didn't take partials in here because it was not 20 handles. It was 10 handles. I should have put a partial maybe there. I'm not sure. But I wanted to target the new day opening gap and the first fair value gap, and of course the engineered liquidity in here. So once again, price breaks, price comes above that. Why did it do that? Is because we have a fair value gap in here, and it wants to take out the premature short sellers in here. Let's see. Also, I saw Patrick Reeland having a Bullflag in here. So this was not the breakout essentially. This was then the breakout of that Bullflag. If we took that vertical line in here, I'm going to draw it out. So Patrick Whelan had something along the lines like this. So this was not the breakout yet. So this, where I took the losing entry, that was not the breakout yet. This is the breakout. So what they do? They enter in here to expect higher prices, but that just didn't happen. And they got wrecked. And they were trying to go bullish. And what happened is, let me draw that down back again. Something like that, right? Or did I? Yeah, something like that. Something like that. So once it trades above in here, what do they expect at the retest? To trade higher, then to take out this again or whatever they do. That's what I did when I when I traded with trading chart patterns and that stuff. So what happened instead is we leave a breakaway gap, and we leave a fair value gap in here, and this is my cue for the short entry. That was the high probability trade that I should have taken. But I'm okay with losing this trade. I'm very, very okay with that. I don't mind it at all. Because I would do this, I would make this mistake for the rest of my life probably. But it's good to see that I did what I did wrong, and like I said, once price trades in here, we take a partial, we trade up in here, we see if we have a willingness to trade above this previous day opening gap. If we do so, then again we want to trade all these buy sides. Oh, God damn it! All these buy sides things to trade the lunch reversal at the PM session, and then have a back and forth in here. But we don't do so. So my once we do that, my stop loss is here. If we do that, then yes, I want to trade for a long entry possibly. But as we can see is that we have a not a willingness to trade higher than that. As you can see in here, we have a fair value gap. We trade above that, then we inverse that, we come back in something like that. We have a high, we have a low, high, no, maybe high, low. This is then the breaker. This candle is then the breaker. So that's the next point where I want to put my stop loss at here, above this high. And then yeah, we never really inverse something in here. We just trade back, we respect that, and then in here, then we don't reverse this, we trade up in here, we immediately reverse that, we trade here, boom, and we trade back up again. We see if we have a willingness, we don't, and we do this. And it was a pretty easy read today, high probability today. And Tanya Trade said, if you said I don't consider Tanya Trades a very good trader. I think she sucks. So thank you for listening. For the people that always listen, there's always one or two people that listen. If you have any questions, please let me know. If I did anything wrong, definitely let me know. And if you are here trading Bullflags, get the fuck out.